Hey, good morning, everyone. Actually, good afternoon, everyone. It's a little afternoon Pacific time on Tuesday, the 2nd of January, 2024. Wish you all a very happy new year. Just going to do the daily charts. I really just want to identify the near-term trends and tell you what the technicals look like. We will also touch on, in fact, we'll start with yields and the dollar. So these are the 5 looks when we look at the S&P, the QQQ, and the Russell 2000 in terms of equities. The other two would be the dollar and yields. To give us a feel for the right now complexion of the trading and what odds favor in the near term going forward. We won't talk about sentiment again, exceedingly over on the bull side of the boat, which when you add it to what we're going to look at on these price charts, makes for a kind of a tough near-term setup. We're beyond that Santa Claus seasonality getting into January. Last couple Januaries have been kind of rough, at least at the onset. So we'll see how things play out. You know, our broader macro view is that the economy is subject to some weakening over the course of this year. Probably recession is our assessment, and the trading in stocks will change in terms of character. Right now, as is happening this morning, markets selling off on prospects for higher interest rates. All of a sudden, in that we were able to flag in the technicals, as I'll show you here in a second. And then intuitively, if markets are selling off, as yields are going up, you would expect the opposite as yields go down, or as the belief that the economy is weakening and the Fed's going to get softer rises. That has been very bullish for equities. There will come a time, we believe, probably during the course of this year, where actually lower yields are going to be consistent with falling stock prices, because those lower yields are actually going to be discounting recession or growing odds of recession. And with recession come dramatically lower earnings than are what previously discounted in stocks. And that's where you get the last leg of a bear market, if indeed that's what we're going to get. So that's our base case still, which keeps us hedged and keeps us relatively defensive. But again, we're open to all possibilities, and we'll keep you posted as we go. So with regard to the current technical setup, here's the 10-year yield. Remember, at the end of last week, we were inside of this falling wedge pattern, and I said this is looking very bullish for yield, which would be bearish for stocks. Very definite bullish divergence. Now that buy signal is growing right here on the MACD. Positive divergence in the RSI as well, coming off of oversold territories. And you can see we've done nothing but go higher. Little gap here this morning, coming off of the highs, but higher yields, which look to be a high probability given the patterns that I showed you here. Same for the dollar, and I said that the dollar and yields in this environment would go up in tandem. Dollar is up pretty noticeably this morning. It was up just under 1% actually, I think 80 basis points, which is a big move for a currency. So you can see we're popping out of the falling wedge, at least so far, and we had bullish divergences coming off of oversold territory here. So both of these scenarios, the way stocks have been trading the last several months, if not the last couple of years, would be bearish on balance for stocks. Here is the S&P 500. As I speak, it is down almost 1%, so 0.95. Remember, we were in this rising wedge pattern when we ran the last video, and here the last 2 trading sessions dropped out of there quite notably. We were very bearish on the RSI, coming off a very overbought with a bearish divergence, playing out just like you would expect based on these technicals. I said the QQQ looked even worse to me. As I speak, the NASDAQ 100 index is trading down 2.28%. So indeed, it's performing quite a bit worse than the S&P. And of course, there's your tech exposure, right? So 2 big gaping daily candles, last 2 trading sessions falling against that 20-day moving average. That's been some support. We'll see how that plays out. Remember, we had bigger divergences on the MACD, similar look as the S&P breaking down here on the RSI. So again, makes perfect sense, particularly when we throw in super high sentiment, which we looked at last time. Don't need to update that yet. and then bullish looking patterns on yields and on the dollar. And then Russell 2000, small caps, like I said, getting way out over their skis. Massive rally. Really interesting session this morning. Started down moderately and then was actually notably in positive territory for a while. But as I speak, down 89 basis points. So it's pushing a 1% decline as well. People really want to rotate into small caps, really want to think that the next bull market and the next expansion is getting underway, and you want to own small caps. I told you that we will when that's our thesis. It's just not our thesis, which says that small caps are just, again, to repeat, way out over their skis. Lots of potential downside in small caps right here. But, if the data continue to improve some and we get a better looking economy going forward, like some people think we're going to get, at least while it's looking that way, small caps could continue to rally. We're about to get a sell signal here on the MACD. And again, like I showed you, we were rolling over off of overbought conditions. If you get a chance, blog.pwa.net. I give you the intro this morning to our monthly equity market conditions update. We actually have an index that we created back in August of 2021. In fact, I'll just go ahead and pull that over here in closing. So this is from this morning's blog, and this is just sharing with you. We don't give you our whole internal report, but we give you a good chunk of it. So in the intro, I said, as we pointed out in November's report, despite an overall deterioration in conditions, strong seasonality was such that a continuation of the then rally, so this was at the end of November, should come as no surprise. From last month's report, seasonality, on the other hand, is very strong right here, so it's certainly not out of the question for stocks to continue rallying, with these extended factors persisting for a few more weeks going forward. Indeed, that's exactly what happened. Stocks were up another 4%, or the S&P was, in December. And while a number of those extended factors indeed persisted, conditions, while still negative, actually saw a notable boost during the month of December. One of the factors that contributed to that boost happened to be the one that market actors are most focused on. Of course, that's Federal Reserve policy. Here's from the body of this month's report. Fed speak has turned notably more dovish, which presents a tailwind for stocks, while soft landing seems to be the current Wall Street consensus. 6 cuts discounted by Fed funds, in our view, can happen outside of a recession. The Fed's more accommodative stance has us upgrading our Fed policy component to positive. Actually, you could view it as negative from a macro overall standpoint because a softer Fed says maybe they're worried about the economy. The way they couch it is that we've done our job, inflation's coming down, we can get softer. So that's an attitude that the stock market loves and did love in December. And that's despite what we're seeing so far here this morning. The go-forward setup, the setup heading into January improved in the context of Fed policy and overall market breadth. We did see breadth come back in a big way, and that indeed is a positive. Serious headwinds, however, the dollar, interest rates, which would be the technical setup for interest rates, which I've illustrated for you, the equity market technicals and sentiment, among a few other things. However, as we enter January, puts the present rally on overall shaky legs. But as we stated with regard to December, it doesn't mean a correction begins right as January gets underway, although that's what I'm sure people are fearing right now with today's sell-off. It simply suggests that the go-forward setup, on balance, remains too precarious to add risk at this juncture. So viewers, keep in mind, our audience and the people who we are fiduciary tied to is the long-term investor whose long-term wealth we're managing to preserve, protect, as well as to grow over the long term. So while we get into the short-term technicals on these videos, and I think it's good to just gauge short-term expectations for the viewers, at the end of the day, we are looking at the big picture. And while January could be special to the upside, it's not looking that way, at least on the first day. I'm talking go forward, the balance of this year and for many years to come. That's what we're looking at. We do think that the prospects for one last leg down in the bear market are relatively high, too high to have us adding risk, as we say, or adding exposure to things like equities right here in any meaningful way. But ultimately, as I spelled out in detail in our 6-part year-end letter, we're bulls on a lot of things once we get through what's left in the present cycle. Thank you as always for watching and listening. I'll be back at the end of the week or over the weekend with another update. Take care. Bye-bye.